All right, with that, we'll get started. Thanks again, everyone, for joining this cross-commodity webinar today. Obviously, we are trying to flash out some key content on metals, on grains, on natural gas, on oil, and also looking at the broader macro picture following Trump's tariff announcement yesterday. Again, thanks for joining. Before we jump forward, keep in mind that the Insights team here at Kpler is covering all of these topics in depth each and every day. We have a number of commodity-focused experts on the call today. They will be covering their respective commodities and taking questions at the end. Again, my name is Ray Dianson. I am the head of macro here at Kpler. And again, I'll be handing it off to Alex to cover our some key cross-commo topics, especially when it comes to equities. Andon will then be picking up. He is our director of oil and tanker research. He'll be talking about the oil market. Laura will be speaking on LNG and natural gas. She is our insights manager when it comes to LNG natural gas. And then we'll be handing it off to Florian, who is a senior analyst on the cross-commodity team, again, finishing up with some other bulk questions around dry bulks and metals. With that being said, let's go ahead and jump forward. First, we need to speak about the macro outlook. Obviously, there is a lot of questions, as Trump looks to implement very aggressive import tariffs. First, let's just kind of level set and talk about where we think things are heading moving forward. Of course, looking at that weighted average tariff rate, this is coming from Evercore ISI. They predict a nearly 30% average import tariff coming into effect in mid-April over the next week or two. Keep in mind that this will easily be the highest tariff rate we have seen since the early 1900s. Albeit, keep in mind that estimates are kind of all over the place around this trade weighted average, anywhere between 18 to 33% in terms of the average import tariff rate. But the overall narrative here is tariffs into the import tariffs for the United States are increasing a lot. We have revised lower global growth to just under 3%. Keep in mind that this is now well below the pre-COVID 20-year average of 3.7%. Just focusing back in on the United States, again, assuming a 0.8% growth rate this year. Again, a 50-50 chance of a recession this year, right? This is an increase of what we were expecting was maybe a 20% chance of recession a month ago, right? So with the current tariff implementation, we now think the chances of a serious slowdown in the United States are much higher than they were a month ago. However, with that being said, we still see concerns of sticky inflation. If you look at, obviously, my comments here on this slide, we see core CPI-based inflation getting stuck in a range between 3.2 and 3.5% this year. We had already been assuming for a sticky inflation assumption of between 3 to 3.5%, but we have revised lower that upwards, that low end of the range from 3 to 3.2. So again, lower growth expectation, higher chance of U.S. recession, and also an expectation of sticky inflation continuing through this year. Keep in mind, we continue to reiterate to clients that the Trump administration is pursuing three key economic policies. One, lowering the rate of inflation. Two, narrowing the U.S. trade deficit. And three, improving defense burden sharing among its allies. Keep in mind, though, that, of course, Trump is also pursuing policies that does not necessarily fulfill these three goals. But when you look at Stephen Moran and some of the other core policymakers within the Trump administration, these have really been core to what Trump is trying to do. However, I think especially that first bullet, lowering the rate of inflation, could be tough given the aggressive tariff implementation out of the Trump administration. One other comment on the United States, there are really questions about the medium and long term for the U.S. I think short term, U.S. is going to struggle economically. The medium and longer term, there's really an open question. Do we get that manufacturing reshoring impulse that the Trump administration is hoping for? And right now, we really don't know. Just assessing where the market is right now, a lot of indicators, concerns around economic growth. Again, the 10-year yield is weakening to levels we have not seen since October, November of last year. Again, clearly indicative of growth concerns. Even the US dollar, relative to a November 1st, 2024 baseline, a lot of weakening. Again, market clearly indicating concerns of weakness. And even when we look at a number of surveys out of the United States, if you look at the consumer survey held by YouGov and The Economist, a lot of folks indicating that the state of the economy is getting worse. Also, when you look at the Texas Manufacturing Index, we have seen both a spike in expectations for inflation, which is that orange line, and a big decline in expectations for business activity, which is that blue line. So again, survey data really continuing to look weak, and that's really guiding our view on U.S. economic growth. Again, a month ago, we were a little bit more skeptical, given the fact that Trump had not necessarily moved forward on aggressive import tariffs. But it does look like he is moving forward on that now, so we are revising down growth. Just one other key point here. When we are thinking about U.S. inflation, again, inflation was already starting to pick back up before these policies had come into play. If you look at the left-hand side chart, core CPI-based inflation on a 6-month moving average basis, that black line clearly has ticked back up. And the concern moving forward is if we look at this right-hand side chart here, much of the deflationary impact over the last year has been a result of goods deflation, right? So that disinflationary trend that has pulled U.S. inflation lower has been driven by, in large part, deflation in goods. Well, that has already started to reverse even before the Trump administration had come into power. We're going to have to keep an eye on whether this continues. It's our expectation that we do see more goods inflation moving forward, again, kind of pushing this sticky inflation narrative that we're holding to right now. Quickly, just 2 more economies before I hand it off to Alex to talk about equity markets. China. China announced a 5% growth target in early March. We do think that they will hold to that target, even if it means an intensification of uneconomic industrial investment. Of course, the narrative that we've been speaking about at Kpler when it comes to China is one of imbalances. They continue to rely too heavily on investment-led growth, too little on consumption-led growth. It is unclear whether they can shift away from that, slowly shift away from that model. There really has not been much conversation yet about who's going to bear the costs of that shift from investment to consumption. But when we're just thinking about growth and how that relates to tariff rates, I think, if you're sitting in the West, there should be an expectation that China will heavily press down on the stimulus pedal to meet its 5% growth target. What's really important is how they meet that growth. If they really push into emphasizing consumption in China, which again has been far too small a part of the Chinese economy over the last 20 years, if they really start to emphasize consumption, that could be positive for a short-term rebound in China. If it's just continued focus on investment, that's already creating a lot of outproduction and a high reliance on exports. And again, if we think about the kind of what we've seen since September, obviously last September, China announced a very aggressive policy of monetary stimulus that has largely allowed the industrial sector to recover. We saw growth in industrial production dropping to 4.5% in August. And then in September, it came right back again, and we're back towards the top end of the range. Of course, this is driving an ever larger net trade balance. We don't see much evidence of this stopping at least this year. Yes, the Trump administration is trying to take this on, but at the end of the day, I think what you'll see is Chinese exporters will continue to export a lot of goods, but margin compression will really tamp down on profitability of Chinese firms. But we're not necessarily convinced we see a big drop in Chinese exports. And of course, when you think about the consumption side of the Chinese economy, continues to look weak. We're at 10 to 15% below trend. We are also in a deflationary environment as well. China, again, if you are emphasizing investment relative to consumption right now, they are far outproducing their domestic consumption base. And so they really do have to sit on exports to support growth. So again, much of the China's ability to kind of step out and step out against U.S. tariffs is emphasize domestic consumption, right? If we go back to this first slide, it's trying to get consumption to be a larger part of the U.S. economy. And just keep in mind, long-term sustainable Chinese growth, they really need consumption at 60 to 70% of GDP. They really need investment at 20 to 25% of GDP. So if we're thinking about China's ability to kind of stand against Trump tariffs, they're really going to need to emphasize a pickup in domestic consumption, because this export-led model that they've really relied upon will come under strain eventually. This year, we'll probably continue to see it trend higher as Chinese firms are already kind of set up for the year. And we'll see what we'll see is a narrowing in profitability. But if we're thinking about durability of the Chinese economy, they really need to emphasize improving the consumption side of the Chinese economy. Lastly, before I hand it off, just speaking on Europe, again, if we're talking about updates to our GDP forecast this year, again, revising the US down to 0.8%. We've revised Euro area GDP growth to 0.7%. Keep in mind, we came into the year assuming a 1.2% growth rate. So this is a significant downward revision. We do think inflation is going to return to trend this year, holding in a range between 2 to 2.5%. The tariff implementation does inject some uncertainty, and so we think the ECB will be cautious, but ultimately we'll get another 50 to 75 bips of cuts out of the ECB this year. Investment pickup likely not going to happen in Europe until next year or late this year, as defense spending and fiscal expenditures via the German government start to come into the market. So again, summarizing the macro landscape right now, U.S. growth prospects have declined a lot. We see growth at 0.5%, but continued sticky inflation. In China, they will push hard to meet their 5% growth target, even if it means uneconomic industrial investment. However, they need to find a way to start shifting towards consumption as a way to stand against relatively aggressive, very aggressive Trump tariffs. And when it comes to the European Union, we've revised growth lower to 0.7%, down from 1.2% to start the year. We do think inflation will largely hold near that 2% range, 2 to 2.5%. That will give the ECB some freedom to cut rates this year, another 50 to 75 bips. One other point, when it comes to Fed policy, which I didn't mention in the first couple of slides, Fed likely in a very tough spot. Lower growth, higher inflation creates a difficult situation. So we think maybe one 25 bip cut from the Fed this year. All right, I threw a lot of macro stuff at you. Be thinking of questions. I'll hand it off to Alex now on the equity side of things.
Thanks a lot, Reid. So yeah, just briefly touching a bit what's happening on the market, or what the market is telling us. So from what we saw since yesterday evening, not 10 but 11 French time, we saw a massive decrease, a big change. Looks like something critical change for the market. We had a difficult Q1 already for the US indexes. Has been one of the worst since 2022. And Europe was one of the best, especially in relative terms, was clearly outperforming by more than 17%. But since yesterday evening, things changed. We have all the indexes now down. We're probably one of the worst day on the market post-COVID. So that's a strong signal that something changed. We are down as well a lot on retailers. So probably a lot of worries, fears on consumption side. As Reed mentioned, we have Nike probably opening at minus 15%. We have Target opening at minus 10. Same for Walmart in Europe. The same retailers are down by double-digit figures. So something the market is signaling us that there are big worries on the consumption side for the next few weeks. That's something actually we will better assess in 2 weeks when the company will release the Q1 earnings and, more importantly, say their outlook for the rest of the year. So the damages are there. Confidence is probably broken. Not sure that can come back as quickly as some may expect. On the commodity side, same. And so we updated the slide on the right side. It's around 2-3 hours ago, but probably outdated already. If I have a look on Brent, because right now we are down between 7 and 8%, probably again the worst day so far for oil prices post-COVID. So a huge signal. Same is true for TTF, down by 7%. We have just natural gas and cocoa, which are up to date, but that's nothing linked to tariffs. It's more weather related. So a lot of things going on commodities, copper as well, where we had that massive spread between LME and CME. But let's discuss a bit more what's happened on natural gas and TI. So starting with natural gas, Laura will discuss what she's seeing.
Yes, hello everyone. My name's Laura and I'm looking after LNG and natural gas insights at Kpler. And the first thing I wanted to talk about today was actually what has been happening before last night's reciprocal tariffs were announced, because we've already seen tariffs impacting the global gas landscape to various degrees. And there's 3 key aspects that I wanted to focus on with regards to tariffs. Now, the first one is that the US put a 10% tariff on Canadian natural gas pipeline imports on the 4th of March. And you can see from the chart that actually the US only imports gas from Canada, and it amounts to about 7 to 8% of supplies. So last year, about 3.1 TCF of gas came in from Canada. And that's mainly been going into the Midwest and the West areas of the country. Now, when the tariff was imposed on the 4th of March, we did actually see a drop in supply from Canada, but it was very short-lived because essentially a couple of days later, the tariff was lifted. So flows went back to normal. But had the tariff remained in place, we looked at what impact would a 10% border tariff have on Canadian gas coming into the US. And essentially, it doesn't change the competitiveness of bringing cheaper Canadian gas into the US. So quite a limited impact from this very short-lived tariff. We have also seen tariffs been put on by China on US LNG as well. This isn't the first time China has put tariffs on US LNG. It did actually happen in the first presidency as well. And China put on a 15% tariff on US LNG on the 10th of February. And since then, we've seen China basically not importing any US LNG. That's really been helped by the fact that Chinese LNG demand has been very weak this winter. China has had a very mild winter with high gas stocks as well. So we basically think that China can pivot away from US LNG to alternative sources of supply. And we have actually seen a pickup in Qatari LNG volumes heading to China now. So China's basically just rejigging its supply to alternative sellers in the market. But of course, Chinese off-takers do take gas from US LNG plants. And instead of shipping that gas into China, they're actually pivoting more of that gas over to Europe, which of course is the premium market at the moment following a very cold winter in Europe. So quite a limited impact from China due to weak demand there. But we do see a bit of a heavier impact coming in from the 25% tariff, which was imposed on steel and aluminium imports. And this is basically because US LNG plants use a lot of steel and aluminium in the plants. So anything from pipelines to structural steel to tanks to heat exchangers, etc. This all uses steel and aluminium, much of which is imported into the country. So there are 5 projects that are currently under construction in the US at the moment, and we think the 2 that are furthest behind, Port Arthur and Rio Grande, are most impacted by these steel and aluminium imports because, of course, there's still quite a lot to come in to build those facilities. But also there is an impact on plants that are trying to FID as well, because in general, prices have been rising, costs have been rising, and we've started to see some of those project operators seek to renegotiate liquefaction fees because of these higher costs. So we really need to think about US LNG and its competitiveness on the global gas landscape as well. So a bit more of a severer impact there. If we go to the next slide, I'll be talking now about what happened last night with the reciprocal tariffs that were imposed. And of course, there's an undeniable macro impact, an impact on growth, as Reid said, and on gas demand. And if we look at TTF prices only today, last time I looked, they were down by over 5%. So a very bearish kind of impact on TTF prices. But we also need to think about the US being the largest LNG exporter in the world. So US accounts for about 21% of global LNG supplies. So we really need to think about how our country is going to counter against these tariffs. Are they going to negotiate with the US, or are they going to put on counter tariffs? So this is what we will be eyeing over the next couple of days and weeks. And here I've just put together a chart which shows the biggest importers of US LNG. And essentially it is by far the EU 27. So the EU has really increased its reliance on generally the global gas market, but particularly from US gas over the past couple of years. Of course, we've had the Russian gas crisis, a big reduction in Russian gas coming into the EU, and that's been offset largely with US LNG as well. So last year, the EU imported about 36 million tons of US LNG, and we think that that figure will actually rise this year because Europe's got quite low gas storages at the moment. It really needs to pull on more LNG from the global market to fill those storages. And the US is, of course, bringing online more US LNG capacity as well to help the refilling. So because of Europe's high reliance on US LNG, we don't think that any counter tariffs, if they are imposed, that they would include LNG essentially. But there are some other markets that we need to be watching out for closely, in particular parts of Asia here. We're looking at Japan, Korea, India and Taiwan. Also, the UK is heavily reliant on US LNG as well. So really kind of over the next couple of days and weeks, we need to be watching out for any counter tariffs and whether they include LNG, because it will have an impact. I'll pass over to Andon now. He's going to cover crude.
Hi, everyone. Yeah, from a little bit of a different angle, starting off with what the immediate impact will be and what we're expecting will happen. So the elephant in the room here is that obviously this subdued economic performance will have impact on product demand. And while we've been ahead of the curve when it comes to projecting demand this year, I'm suspecting the likes of IEA or the EIA will also be following suit soon, converging their projections with what we had before. We also, in solidarity with this deteriorating macro environment, are cutting our expectations for demand growth but only mildly. Why? Because in our previous base case, we already started factoring in the recession-like environment that we're in right now. Whether it is an actual recession or not, we will leave that to the economists, but the impact on product demand is definitely going to be there, and it's definitely going to be notable across the board. Mostly felt in the middle of the barrel with gasoil, most closely related to economic activity, as well as naphtha demand. We also see struggling steam cracker operational rates in the US, which is what is going to start weighing on NGL demand. Now, what does this also mean is, well, right now, cracks are in a relatively good shape. As you can see, the beginning of the year has been very generous to refiners, and crack spreads right now are relatively in good shape. Things will probably remain in this macro environment for the next couple of days, because when it comes to product markets, they don't move that much in one direction or another based on news. However, as we move further, the deteriorating demand environment implies something else, and this is the boogeyman of refining, which is lengthening balances. And while seasonality is definitely with us, this year we'll see quite a significant lengthening, much above last year's levels. And Reed, if you go into the next slide, which also explains why, as things stand and as our current global balance projections are suggesting, we will be seeing essentially every single month of this year being longer than it was last year. We have plenty of reasons for that. There is the dichotomy between how hard will the US go against Venezuela or Iran, or whether Iran is going to be able to sell more into Shandong independence or whatever. While all these are valid factors, you cannot have north of 1.5 million barrels per day of net capacity additions in H2, and OPEC Plus announcing additional 400 KBD of supply production hitting the market come May, and expect that the relatively limited declines across Iran and Venezuela are going to hold the line for crude prices and keep them into the high 70 range. Now, for now, we hold the line here in our base case at around $70 per barrel in the immediate term. In the next couple of days, is definitely to be expected that prices will be testing, say, $79 to $70 per barrel. But we do believe that the market will eventually start returning to what fundamentals say, and fundamentals say for now, prices should recover a little bit in the next couple of days. However, keep in mind, we are in this constant modus operandi where we cut our projections. And if 2 months ago we were thinking about $75, $76 per barrel, right now we don't even see 74 anywhere on the curve. And if you remember anything from the crude side of this presentation or any of that, just remember things have gotten a lot worse, and we should not discount an OPEC intervention at some point when prices start falling into unsustainable levels. And with that in mind, I pass the baton on to my colleague Florian, who's going to be talking about metals.
Thanks so much, Andon. Now, bear in mind that the US is heavily reliant on imports of copper and aluminum, contrary to crude and nat gas. So now let's start to decipher what we know so far regarding the import tariffs. You can see there's 3 main trajectories of tariffs on metals. The first one is the so-called Section 232 tariffs that were applied across all aluminum and steel imports. And they remain in place, and they amount to 25%. Regarding copper, there's an ongoing investigation into these Section 232 tariffs, and potentially we see them being implemented soon as well. Now, the second trajectory is the IEEPA, and it distinguishes between imports that are USMCA compliant or not. Most of aluminum, steel, and copper imports into the US from Canada and Mexico are compliant. And for these compliant commodities, yesterday, Trump announced that this waiver will be extended, meaning aluminum, steel, copper from Canada and Mexico will not be subject to an IEEPA tariff. And the last trajectory introduced yesterday is the so-called reciprocal tariff. And this applies to individual countries. However, specifically the commodities under Section 232 do not fall under it, meaning they will not apply to aluminum, steel, or potentially copper. Next slide, please. So what does this mean for copper markets? Copper has rallied this year, however, has come off already over the past weeks and especially yesterday. Overall, we do see renewed price upside up to $5.40 per pound. First of all, so far copper has been spared from tariffs. However, these Section 232 tariffs are still on the table, and it's likely that they will be implemented at some point in Q2. Secondly, the US boasts a very high import dependence of around 45% of its demand that it needs to import. And at the same time, a ramp up in US copper production in the near term is virtually impossible. Mining lead times in the US are among the longest in the world, typically around 20 years. And yes, the Trump administration pledged to streamline these processes. However, even if you look at these lead times in countries such as the Democratic Republic of Congo, where it takes less time usually, even there it's a project spanning a decade to get a mine from envisioning to really operating. Also, the more immediate bottleneck that the US faces is not actually mining, but smelting capacity. The US is a net importer of refined copper, but a net exporter of copper concentrate, simply because they do not have sufficient smelting capacity. So in our view, it's likely that the US will, rather than trying to ramp up mining, they will try to improve their smelting capacity. However, even if they smelt all domestically mined copper, the import reliance would only drop from 45 to 30%, meaning the US will remain a large importer of copper for the time being. Regarding the transatlantic spread, COMEX LME, we do not see additional upside. We are standing at a 15% premium right now, and our forward flows currently suggest a strong uptick in flows March and also in April, as you can see in the chart. Now, moving on to aluminum. So as mentioned, there's the 25% tariff on aluminum. It will remain in place for now, whereas imports from Mexico and Canada will receive, or the waiver will be extended, and it's not subject to the reciprocal tariffs. For the time being, similar to copper, the US will remain a major importer of aluminum. It also has an import reliance of almost 50%. And again, a ramp up in domestic supply is very, very unlikely in the short term. The US does have idle smelting capacity, but it's very old and likely even not competitive with the tariffs in place. However, last month there was an announcement. The UAE aluminum producer EGA announced that they will build a smelter in the US. However, this is a matter of many, many years before it becomes operational. The main import of aluminum into the US is Canada. It accounts around 55%. And we do expect that Canada to US flows will come under pressure. Canada relies more on the US than vice versa. Like 90% of Canadian exports go to the US. So we do expect that the UAE will probably send more aluminum to the US and Canada will shift towards the EU. Overall, Atlantic Basin bauxite demand will come under pressure from that. However, the big producers in the region, which are Guinea and Brazil, they will likely shift these volumes to China and India. And overall, the bauxite market will become more China-centric as a result of the tariffs. Now we're moving on to our last commodity sections, which are grains. Now, again, here we have to look at it from a different angle. The US is, contrary to metals, not a major importer, but it's a major exporter of soybeans and corn, meaning the most relevant impact will actually be retaliatory tariffs. China has already a month ago implemented such tariffs on soybeans and corn. Mexico so far has refrained from implementing retaliatory tariffs, which is a very important point we will touch upon later. This week, the prospective planting report from the US was published. Corn acreage went up strongly and notably higher than the soybean corn ratio would have suggested. And this is clearly a trade war effect. China is the world's largest importer of soybeans, and it buys more than 50% of US exports. And at the same time, also bearing in mind the last trade war in the years 2018-19, China has diversified strongly its soybean imports. It shifted towards Brazilian volumes, and at the same time, Brazil is having a record harvest this year. So contrary to 6-7 years ago, China can more easily shift away from US volumes. So we do expect China to build stocks using Brazilian imports, and we expect US to China flows to drop by 50% this year and the next. However, bear in mind, there will not be an immediate tariff impact because US to China soybean flows only start in October. Also interesting to note the Brazilian harvest, which is at a record level. That's something you can track in real time on the Kpler terminal. You can see the aggressive exports in March. You can see the huge lineups and also the port congestion in Brazil. Overall, our outlook for soybeans in the US is bearish due to China shifting to Brazil. However, there's a floor to prices given that soybean acreage has come in relatively low. Moving over to corn. Now, the big message here is Mexico, who is the largest buyer of US corn, they take around 30 to 40% of exports, has not imposed retaliatory tariffs for now. This is very relevant because the US to Mexico corn flows are very stable and steady, contrary to soybean exports, meaning a tariff from Mexico would have an immediate impact on the US corn balance. So overall, no tariffs from Mexico so far, and at the same time, we expect US corn exports to the rest of the world to remain relatively strong, simply because we still see weak exports from South America and from Ukraine. Chinese buying has been very weak this year. However, this has been partially offset by higher buying from Iran and North Africa. Overall, our outlook on US corn is still bullish, despite potential retaliatory tariffs coming up. And so this coupled with the weak outlook on soybeans shows that the soybean corn ratio will likely weaken further. Regarding, because it's a frequent question, a ceasefire impact on grains between Russia and Ukraine, we think the impact would be relatively limited. Bear in mind that Russian exports have not really been disrupted much, and also Ukrainian exports have recovered, and last year they stood at around 3/4 of pre-war levels. Very briefly, a last mention of wheat. Our outlook here is bearish. There were significant supply concerns because of potential winter kill in the US and Russia. However, this did not turn out to be dramatic. Concerns have subsided, and at the same time, global demand for wheat is relatively weak, so our outlook for wheat is bearish. Our last section, before we move on to the question Q&A, is our commodities positioning. Kpler will launch a weekly commodities positioning report this month, and in this report we try to provide an aggregate view of what's going on in terms of commodity positioning. We deem it a very relevant topic because, especially for the more volatile commodities, considering that many short-term price fluctuations cannot be explained by fundamentals only, but positioning plays a very large role, for example, when it comes to net gas. In this report, we will highlight outliers in terms of positioning. So, for example, here you can see silver and coffee, both showing signs of an overcrowded position. You see that the long-short ratio is more than 2 standard deviations above the historical mean. So, for instance, in this case, we expect a trend reversal. Yeah, thank you for your attention, and we're happy to take your questions now.
We're here. Yeah, thanks everyone for that. We're going to go ahead and take some questions now, and I am very dark, so I'm going to change my camera here. But as we move forward, please just ask questions as they flow through. We would love to take them and speak further on what's happening across the commodity landscape with any Q&A that you have. We've got some stuff flowing through here, so I'll go ahead and start with some questions around Asian macro. It looks like, speaking for APAC, most markets are struggling with large household debts and now possibly lower foreign direct investment and high inflation. Any insights on how Asian governments will do to revive domestic consumption? I want to go ahead and let's just focus in on China, because I think when we're thinking about East Asia and the Asian economy more broadly, it's really a question about what's going to happen in China. You know, as I showed you early in this presentation, consumption is too small a percentage of the Chinese economy. They really need to increase that. I would start to feel more optimistic if with 2 potential outcomes. First, the Chinese government really starts to commit to broader transfers to households over long periods of time. This means very aggressive expansion of the social safety net and direct fiscal transfers to households. They are doing some of this right now. We've seen some stimulus impulse this year. But number 2 is a real conversation about who's going to bear the costs of this fiscal transfer. And again, this cost is going to be bared, you know, if you're shifting 100% of you have, you know, an economy and X% of its investment, X% of it is consumption, and you want to increase consumption as a bigger part of the whole, that means investment needs to decline. And basically what that implies is businesses accepting narrower profit margins and paying out larger wages, and also the government taking on larger amounts of debt, right? So that balance is really still an open question, and we haven't seen a lot of conversation within the Chinese policy-making sphere yet about who's going to bear the cost. So just on the Asian demand question, that's what I would be thinking about. Andon, I'm going to come to you next. We have a question on ULSD. Considering the bearish revision on growth in general, what are the expected impacts on ULSD, bearing in mind the demand from the retail industry in the US in the short term?
Right. So, yeah, good question. In the wider middle distillate complex, we see mounting pressure for cracks in early H2. The impact for the US, well, the US diesel demand has really underperformed last year, which came as a little bit of a countering to the pretty robust GDP growth situation. And now we have a bit of a reversal, right? Like, we are lowering GDP growth to 0.7%, as Reid pointed out. But it's important to point out that the correlation there has really been broken and weakening for quite some time now. So we expect that essentially the mild correction or the mild growth in US gasoline demand that were to happen previous to this is now not going to happen. Essentially, we expect that US diesel demand is going to replicate last year's levels for better or worse. Implications for the wider market. Well, this also means there will be more available product for exports, which is adding even more into the glut that is mounting towards, as I said, early Q3.
Awesome. Thanks for that, Andon. We're going to stay with you for another question on OPEC Plus. And I think it's a question on the minds of many of us. If we do see a material breakdown in prices, and I think, you look at the key technical level on Brent is around 69, 69.30. If we see a considerable break below that level, what do you think? How do you think OPEC Plus could respond in that situation? Do they allow prices to just play out, or do they step in?
Well, OPEC has continuously committed to this responsible role that they claim to be playing in the oil market. The easy answer that, of course, everyone is now considering is that if the prices fall, they're going to open the taps and they're going to cut production and then essentially help the prices recover to something a little bit more palatable for the countries with high break-even costs or debt levels or whatever. Now, there are a couple of things to consider though before making this call. A, stocks are low. B, cracks are high. C, we are still in maintenance season, which is about to begin in the east of Suez, which is obviously the biggest demand center on the planet right now, or at least growth center on the planet. So if we are thinking about the fundamentals, there are good reasons to expect a mild recovery in prices, at least in the next couple of months. If there is a crash and if things go into really negative situation, then yeah, that would probably be the response from OPEC Plus. On the other hand side, though, today's decision, regardless, of adding a little bit more crude than previously anticipated or announced, adds one element of uncertainty into the equation because it kind of goes against the other narrative that I just outlined. So, without trying to make things look like I know more than I do, I would say there is probably something at play here. Maybe there is a revival of the U.S. shale trade war that was happening or before. I don't know. If that is the new reality, then we should brace ourselves. But I would say the chances for this happening are rather on the low end of the probability curve for the time being.
Awesome. Thanks for that, Andon. Laura, going to hand off to you next and talk about some European natural gas and LNG. What other main supplies to the EU could come if EU member states would like to reduce dependency on US LNG? So what are some alternative suppliers?
Yeah, it's actually really limited, to be honest. Europe is really, really reliant on LNG now. There's very limited domestic sources of supply. So European domestic production has been declining. There's no new material gas fields coming online in Europe this year. So from the domestic side of things, it's very limited. Norway is pretty much maxed out. Algeria, Azerbaijan can't supply any more gas to Europe either. So it's really coming from, LNG to support the European restocking efforts this summer. So if Europe wants to reduce its dependence on US LNG, it's going to be very difficult to find alternative sources of supply because there's no new additional sources of supply coming online, bar what's coming out of the US. There's a bit of supply coming from Senegal and Mauritania, and there's a new project in Canada, but that's on the West Coast, so that's going to be targeting Asia. So, if this is the case, competition between Europe and Asia for LNG supplies is absolutely going to rise, and that's going to support prices on both the TTF and JKM.
And just to kind of build on that, because I've heard some questions around, China positioning. And of course, right now with the trade barriers growing up in the US, there's just a lot of talk about, democracies maybe, allying together in certain parts of the world. China may be looking to move away from sourcing LNG volumes from places it doesn't necessarily agree with politically.
Yeah.
So do you think, over the medium and longer term, does China look to diversify away its LNG sourcing from places like Australia and, of course, the United States now Or do you think the status quo kind of continues?
Yeah, I mean, in terms of what we've been seeing in China, they're really trying to push this self-sufficiency kind of argument. They're really boosting their domestic gas production. I mean, their 14th five-year plan, they had targets in place for domestic gas production. We've been seeing it growing about 7% each year. They're also importing more pipeline gas from Russia as well. So they're increasing their reliance on Russian pipeline gas. And then LNG is just simply the swing. So Chinese players are becoming more like traders in the market now. So when they want the LNG, they'll take the LNG. But in years like this year, for example, where it's been very mild, they can sell that LNG elsewhere, particularly the US LNG, which we're seeing going into Europe at the moment. So China is becoming a bigger trader on the market, depending on where their domestic gas balance is.
Got it. Awesome. Thanks for that, Laura. Flo, I'm going to come to you next. We have a question around mine licensing procedures, deregulation. Do you think that the licensing for mineral projects in the United States will be sped up under the second Trump administration?
Yeah, absolutely. So that's something that Trump has reiterated over the past weeks, that mining lead times should come down. But as I mentioned, yes, they will come down, but if they come down from 20 years to 10 years, there's still no immediate additional supply coming online in the US. Interestingly, the big miners such as Freeport, they have resorted to rather short-term measures, for example, where they try to extract copper from low-grade ores that is currently on huge waste piles next to existing mines. And with new technology, they try to extract copper that in the past they were not able to extract. So they are short-term attempts to increase supply, but until a new mine in the US comes online, that would take at least 10 years.
Awesome. Thanks for that, Florian. A couple more macro questions, and then we'll close out this chat. First, just a comment on Chinese GDP expectations. Something I reiterate to clients a lot is that the outright Chinese GDP target is a target. The government is trying to hit that number. It is not a reflection of past activity. It is more important to pay attention to how is China growing? Are they growing via the investment channel, or are they growing via the consumption channel? If they're growing via the investment channel, that is just exacerbating the problems that they have in China right now, and that is overproduction and underconsumption. So again, this is why I don't want to focus too heavily specifically on Chinese GDP, because it's ultimately a target. It's what the government wants to hit. Again, as I mentioned early in this presentation, if they focus again and double down on more investment-led growth this year, that just exacerbates the problem in China. If they really try and start to take on the underconsumption problem, that could be positive for a short-term rebound and improvement in the outlook for China over the medium term. We also have a question on, do you think EU members will increase expenses towards defense? Absolutely. We've seen a number of commitments for defense spending. We've seen Germany even, remove the debt brake. The European Union in general looking to spend more money and remove restrictions around deficit spending when it comes to defense spending. Even, public infrastructure, 500 billion coming from Germany. However, keep in mind, this will take time to flow into Europe. We don't think it will have much of an impact this year. It will start to flow through next year. What Europe needs to be careful about, though, is pushing too much money into the system at one time. Because if you do that, you will outpace capacity of production, and it will cause a lot of inflation. So I think, yes, it will have these spending programs will have a positive impact, but likely it's going to be a slow burn over the next 5 years or so, hopefully, and that will add, support for investment. If European countries just flood to the market next year and push tons of fiscal stimulus at the same time, it will cause a lot of inflation and may not be as positive for real growth. So again, we're kind of looking for, what's the rollout strategy? And of course, during the Biden years, right, we saw this very intense push for fiscal stimulus, but a lot of it was just inflationary, right? You look at like real US infrastructure production in the Biden administration, it was actually below the 20-year average pre-COVID because so much of that spending was just fuel inflation. So something to keep in mind there. It looks like, Alexis, I'm going to hand it off to you. To go back to this China question before we sign off here, just to give a brief overview on where you see the steel sector going, and to kind of complement what I've been saying on the macro side.
Yeah, thanks, Reed. So I think for China, we always look at the steel sector is very much investment driven, all the things Reed's talked about already. I mean, China's steel production has been contracting. It contracted last year. We expect it to contract again this year. They have been keeping their steel sector afloat by exporting both steel in the form of finished products to the US and other markets, but also sort of unfinished products, semi-finished, to local economies, in a lot of it in Southeast Asia. Vietnam is a big one. So you see a lot of the arguments about steel coming from Vietnam going to the US as sort of re-exported Chinese steel. There is some truth in that. And even with, before these announcements, we were seeing reports that, Chinese mills are cutting production, not just because the government is ordering them, but because the economics are pretty bad for the Chinese mills. The margins are not great. If you look at where the met coal price has gone over the last 6 months, it's absolutely collapsed. But actually, the iron ore price has been pretty resilient. So that iron ore price has sort of, weighed on the margins at the mills. That is going to have to come down in the near future, because the weaker outlook in China, all the problems Reed's mentioned, add on top of that tariffs on steel trade, not just by the US, but by other markets as well. So Europe, Southeast Asian countries, many others joining in the act is just going to put more pressure on those heavy industries. And yeah, we expect Chinese steel production to contract by probably close to 2% year on year in 2025. And that would be, a contraction 2025, 24, 23, 22, 21. So you can see the direction of travel, and where that's, where that sector is going.
Awesome. Thanks for that, Alexis. With that, we're going to wrap it up. We're on the hour. Again, thanks everyone for joining this webinar. If you're not aware, we do have a research offering at Kpler. Email sales@kpler.com if you want access. And again, you can start to read our daily research on all of these topics in depth. But again, thanks for joining, and we'll see you next time.